Well, it's my pleasure to introduce an old friend here today. Uh, Peter Raber, our speaker for today, is the president of Aldebaran Financial Insights, a well-established company here in town. His father began, and he has taken over, which deals with independent investment advisory information for people who are looking for help in that direction. Peter is a native of Kingsport, like many of us here. Looking around the room here, perhaps half of the members are people who were not here when Peter was an active member, and as a matter of fact, was the president of this club about 12 or 13 years ago. So it's good to see success still around and still looking youthful, and a key part of the local community here. Peter graduated from Emory Henry College, or I think it was university by the time you got there, with a BS degree in economics, and was president or was captain of the baseball team his senior year, and has continued to have baseball in his blood since then for several other reasons. But he apparently was the first person that came along at Emory Henry that could pitch left-handed and also catch left-handed. I'm told that was not in the same game, but it was, apparently he was very flexible. Peter went on and got his MBA from East Tennessee State University, and he has a business relationship with those people even now, which I'll talk to in a minute. And he came to work for AFI, that's the company name, Aldebaran Financial Insights, full-time in 2003, working for his father. But I understand that he worked for his father at a very low minimum pay level for about 20 years before that. He started when he was 11 years old. So this is a man who's got a lot of experience, and he kind of grew up with him. Anyway, he's been actively in the AFI business for over 20 years, in businesses, in financial planning, in tax strategies, wealth planning, and the management of income and retirement and all the other things that all of us have some play in every day, and hopefully live long enough to benefit from all the benefits that he and people working with him help us to retain to live on. He also is a graduate of the Dale Carnegie Leadership Program, so he's got the good touch to go with all this other financial stuff that we know about. In his community involvement, as I've already pointed out, he was a past president of our club here, and he has been very, very active in the community for many, many years. One of the areas that he's been active in, and his father was also active in, is a business that involves millions of dollars a year. For example, he is on the investment committee for East Tennessee State University Foundation. These are not pennies and coins. These are bucks, big bucks. He's worked in the treasury area for Mountain Empire Community College, a small organization in Southwest Virginia, but one apparently who has been favored by a great deal of alumni involvement and collection of money to push the process forward. He's also on the investment committee for Northeast State University, community college it is. Also, the Boy Scouts of America. You know, I don't think about the Boy Scouts of America being wealthy, but there's a lot of money that flows into a successful organization like the Boy Scouts of America. He also has coached and refereed in various youth leagues in the area, particularly with baseball and, to a lesser extent, basketball. He's the past president and treasurer of Meals on Wheels, a very successful outreach program here in our community. And it's been active in many other activities. Going back to baseball for just a minute, uh, I was going to sing this, but I won't do it anymore. But Peter has three sons, all of whom are involved in baseball, and Peter is involved in baseball himself. And it made remind me of the song. And in fact, I almost was forced to sing this song here. But there's a song that we all know about that says something along the lines that if you have 9 sons in a row, baseball firms make money, you know. So here's another avenue for AFI that apparently is in the teaching and learning stage at this point. He and his firm have just moved into a new office building in Colonial Heights and are getting well situated. He was just talking a minute ago about everybody's got a chair where they can sit down now. That's a step forward to get to a point where they can operate well. So with that kind of background, Peter is here to discuss the U.S. financial situation as influenced by record national debt and continuing inflation. So please help me welcome Peter Raber.
Thank you, Ken. That was too kind. And it's a tremendous pleasure to be back here today, seeing so many familiar faces, seeing some new faces. And a lot of you all know my story. And for those of you who don't, I learned at the feet of the best. And yeah, Dad didn't waste a whole lot of time. He said, you got to get to work. So in doing this from 91 on, you see a lot of different things. You see a lot of different cycles. So hopefully that can be of some help as we go through this. Please don't hesitate to stop me and ask questions. I'm sure I've got a slide here in the back that says questions, but I'm much more comfortable with just a back and forth. I would be remiss if I didn't point out that when I was kind of stepping away and being less active in the club, I was really thrilled that Brian Brummett was able to join the ranks and keep us connected and be involved and carry on that tradition. So I'm really grateful for that. I know we're in that series of talks where we have a lot of military people. I know we had one last week and there's 2 more coming up. So I do have some stuff in here thinking towards the connections with national security. And then, of course, you wake up today and, with what's going on in the world and with Israel, Iran, none of that stuff's up in this deck. You don't have time to change. But the world is changing every single day. And so that's a big thing of what we help people with, is trying to figure out, well, where are we going and what are we doing on a daily basis? I'm sure there's a lot of things on here that you've heard it said one way or another, but just to go through, what really is inflation? It's just prices going up. It's a way that we try to keep score on where we're at and how much our money is able to buy. So, they track it in a lot of different ways. The most common one, the one you hear in the news all the time, is the Consumer Price Index. But really, it is just, it's caused by a lot of different things. And I think that's my biggest gripe with the news, with media, with headlines, is we try to make these things zero-sum games. There's one reason for everything, and it's very rarely that. So, it could be demand. It can be just generally raising prices out of companies. It can be government policies. There's a lot of things that play into inflation. And kind of the biggest thing that we try to do is work with people to say, well, what does that really mean? I always find it helpful to look at where we've been in the past. So this goes back to 2013 through today. That blue line is your average inflation rate, give or take 3.16%, right? That's why every economic model, when you hear them talk about it, is, well, if we're averaging 3% inflation, that's kind of what we're looking at. But that's a pretty wild ride to get to 3%. So the yellow line is the cumulative inflation during each of those decades. So clearly the 70s and 80s, kind of where that peak, we were up on the way up in the 60s, peaked in the 70s, started drifting down in the 80s. And I think this drop from starting in the 70s all the way into the 2010s are what have really played into why the most recent bout of inflation has felt so bad. We got used to it getting cheaper. And that's one of those things that the definition of inflation, when we talk about inflation coming down, it doesn't mean prices are coming down. It just means they're not going up as fast. And I think when we talk about it and we hear headlines and we hear, politicians or news people talk about inflation coming down, the impression would be, oh, my prices should be coming down. It's going to be cheaper at the grocery store. It's just not. That's not. We haven't seen that, with the exception of if you go back in the 20s and 30s, is when we actually saw deflation. And we don't want to go back to the 20s and 30s, the Great Depression. So we do want some level of inflation. We just want GDP to grow more so that we're making more as the economy is continuing to grow. This recent spike in inflation, really, if you look at like 21 through 24, it hurt so much. One, because we got used to cheap money. We got used to prices not going up. We were having inflation that was in the 1% range. And if your wages are going up 4% and your prices are only going up 1%, things feel all right. The problem, though, is we got used to it. And so coming out of the Great Recession, there was a spike in savings and people were holding on to money. They weren't spending. We had low inflation. There was that feeling of, is it another shoe ready to drop, with how scary that was. And it led to a massive amount of change in behaviors. And as we've worked our way out of that, and then once we ran into a few other things that started spiking inflation, it exacerbated. So we had just the feeling of, okay, the further you move away from something, the less vigilant you get, so people start spending. Then you have the stimulus payments that come in from COVID, which the math on that, the money that came out of the economy because of job losses, the money that got pumped into the economy by the government, there's a lot of things that go into it. But I think for me, this is the biggest thing. It used to be that our luxuries were expensive and our daily lives were cheap. And it's flipped. So now our daily lives are significantly more expensive and our luxuries are cheap. So you think about your iPhones, your flat screen TVs, all the electronics that now are a fraction of the price that they were. Our ability to travel, in an airline or anything else, those things have gotten significantly cheaper than they were as a percentage. But our rents are going up, our housing prices in general are going up, our groceries are going up, all those day-to-day things that we have to spend on. We don't have the, if you don't want to spend on a luxury, it's your choice. If you have to not, spend on your day-to-day things, then we're working into something that just hurts a lot more. And the wages are kind of the one that, for a lot of people, have hit the hardest, because we traditionally have 3 to 4% growth in wages. Sometimes you get up to 5, sometimes you're a little bit lower. And like I said, if we're lower inflation than our wage growth, it just doesn't feel. So you have this people feeling poor even if their income hasn't changed kind of phenomenon that we're going off of. And that's why I think when we get these spikes in inflation, so we had like 5, 7, 9 type percent inflations off the back of one, it just hit differently this time. And I don't think that we were ready for it. And there was a significant number of people coming into the economy who, for the first time in their working lives, were experiencing it. And so, if you entered the workforce in the 80s, you had seen nothing but declining inflation rates. And all of a sudden, we're flipping that. So it wasn't something that we were necessarily ready for. You couple that with all the other things that you hear in the news, student loan debt going up, all the things that are making things expensive. And it kind of got to the point where we were like, how bad is this? So inflation, for me, we can control it. The one thing, kind of before I talk about tariffs, I would say is when we talk about tariffs, a lot of times we're talking to investors like, what should I do with my money? If I had told you in 2020 the inflation that we were about to see, I would imagine a large number of people would say, well, let's buy TIPS, which is Treasury Inflation Protected Securities. Yeah, that traditional, thought process of buying inflation protected bond instruments wouldn't have been the right move. That 5-year number is only at like 1.5%, even though we've had the worst inflation that we've seen recently, right? Inflation, typically the best thing for it until you get to hyperinflation is the stock market, because it's outperforming, the rate of inflation. So if you've got the stock market earning 6, 8, 10%, depending upon whether you reinvest dividends or not, that's outpacing that inflation until you get to the point where hyperinflation sets in. And then you do start to see things, and you have to have extended hyperinflation to see things like gold and precious metals really accelerate for an extended period of time. But anything that's fixed income driven, if you're earning 3 or 4% in a CD and you're inflating at 5% or 7%, you're losing money in terms of buying power. So that's a big part of, well, how do you deal with inflation? There's the cash flow issue in your own, how do I deal with it at home? How do I deal with my budget? But from an investing side, it really normally feels, and there's a big disconnect in this, is that I should be more exposed to the stock market. So we've got inflation. That's got to be bad. Yeah, but the stock market's about the only way to go around it, and other higher returning investments. So whether that's in real estate that you know how to do appropriately, that you're in those higher percentages. But that's kind of, the thought process on how do you deal with it from an investor standpoint. I wanted to talk tariffs just real briefly. I try to always keep my comments politically neutral, because I realize there's all sorts of opinions on this. In general, are tariffs inflationary? Yes, on the short term. There's about 0 ways to get around that. So if we raise the price of goods, unless the supplier takes on that entire cost, there's some level of inflation there. We don't really know how much. And I think that's one of those things, kind of like I said, going back to the general nature of news media, is they make it sound like it's exactly one thing or another. We don't know, because one, we don't know how long tariffs are going to last. We don't know how much each individual company has inventory to offset the amount of tariffs. We saw GDP go negative in the first quarter, and it was completely because a lot of major companies brought in a lot of inventory right before the tariffs hit, which for them made a lot of sense. And so they're working through some of that inventory. Now, if you're a small company or a mid-sized company, you may not have the ability to do that. So that's, for me, kind of the big concern, is how much damage is being done to small and mid-sized, that growth engine of America, and whether or not they're going to be able to hang with it. I was talking to one group, it wasn't too long ago, and they were referencing the fact that, like all these little rubber ducks that you see on Jeeps all over the place now. And the person who was importing them, their cost went from 30 cents a duck to 50 cents a duck overnight. Well, if you're Walmart and you're bringing in millions of ducks and, you can hold over inventory, that's one thing. But if you've got a 10,000 duck order and that's what you were trying to work off of, it's a completely different problem. And so we don't know what's going to be the long-term effect. We also don't know the long-term nature of these tariffs, in that what we've really seen in the stock market is every time we've seen a deal made, whether it's the UK deal, whether it's the China deal, whether it's Canada, Mexico, or a pause or whatever it is, stock market rallies, right? We may be at a completely different tariff level than what we think we are. And I always kind of have looked at it like this. To me, it very much feels like, my wife showing me a couch that's $4,000, and then coming back a little while later and showing me a $2,000 couch to replace the couch that I don't need to replace. But that $2,000 couch looks a lot better than the $4,000 couch, right? So we're going to settle somewhere, and it will be higher than where we started going into this, thing. But we just don't know where, and we don't know for how long. We don't know if Congress is going to do something that completely reverses these. So that's where the stock market has felt a little schizophrenic this year, is because if anything, the stock market hates its uncertainty. And there's too many factors that are pushing it in opposite directions. And depending on the given day, you have one group that's winning. and sometimes that's a group of computers. So that's kind of been the biggest thing with these tariffs is as we move through them, we'll see. And that's where then we get into the long term. We'll know what the end effect is. But even if you look at, projections from both sides, they put so many caveats in these things that you can't really play. You don't know, how much manufacturing is going to come back. You don't know what type of manufacturing is going to come back. I know that if I was building a plant in the United States right now, I'm not going to build one that's worker dependent. It's going to be automated. It's going to have robotics. It's going to have all that. Now, maybe that's bringing back higher paying manufacturing jobs, but we just don't know. You have a lot of companies who have come out and said, look, we can't move. We might want to. There was one of the jewelry stores was talking about like this 100-year history of the workforce in, I think it was Thailand, or it was Vietnam. And they were talking about, they know how to make this stuff, like to change workforce, they won't do it. So then they're going to have to figure out a new pricing structure. So it'd be nice if we could say this to that was a direct line, but we can't. I'm an econ grad. Brian's an econ grad. We love our phrase, holding all other things constant. Nothing's ever constant, right? It's just an easy way to say, well, in general, if we hold enough of these things constant, we're going to move. So that's kind of the thought on inflation is it has slowed. We're at 2.4 right now. And I think, the Federal Reserve with their mandate, I don't see them doing anything on inflation, maybe until there's a new Fed chair next spring. Clearly, Chairman Powell isn't going to move unless he sees data that is driving that. So Chairman Powell has been very clear that his two mandates are full employment, and we've got, still adding jobs, and controlling inflation. Don't think that he has a big care about controlling the cost of the national debt. Or if he does, it's a very distant third. And so as much as maybe President Trump would want him to do that just for that reason, I don't see Chairman Powell moving on that. So speaking of the national debt, how bad is it? It's bad. Maybe not as bad as we feel like it is, but it's bad. $36 trillion and counting. And there's a slide coming up from the U.S. Debt Clock. You can go on usdebtclock.org or .com, and it will tell you second by second how much this stuff's growing. It's scary. I've got a picture on here, so at least it's static and it's not constantly going up. But who owns it? 55 is U.S. investors and U.S. holders of various capacities. 25%, and this is the big worry, is held by foreign governments and investors. The Federal Reserve has 13. Interdepartmental is 7, so that's where Social Security loans to Department of Veterans Affairs or whoever they loan it to out of their budget to make things work on any given year. So it's not quite as clear cut as we have 36 trillion that has to be paid to one source. There's a lot of interdependencies that go along with this. I wanted to talk a little bit about the foreign investors. So the big three are Japan has a little over $1 trillion, China has a little under $1 trillion, then you got the UK, and I think they're at 700 billion, somewhere in there. Those three own 30% of our debt. And the worry always is that, well, what if China decides to sell all their debt? What does that do to us? It would hurt. It would probably hurt them more. And that's probably why you're not seeing it happen quite as much. And the thought process being that if they sell the U.S. debt that they have, that's going to convert to wons or yuans, and that's because they're an exporting country. That's going to increase the value of their currency. It's going to make it more expensive for them. So it hurts them as well as, hurting us. And the question is, it's kind of like everybody's got a match sitting there, and do we want to throw it on the fire to do some of this stuff? Japan and the UK aren't going to actively attack us at this moment in time. Who knows what's, countries change their stances going forward. But China's really the one that's out there. And there's some other things out there within China where they want their citizens to hold currency in a certain way that, yes, it's a problem, but it's not maybe as direct of a thing as like all of a sudden if we make them mad in some way that they can start that that process and not be affected by it. So it is a problem, but it's not maybe as direct as it would seem. I kind of look at it this way: are we the best house on a bad block? So this is at usdebtclock.org. There's our 36 pushing 37 trillion. Public debt to GDP, about 100 on that clock. If you look at other metrics, we're about 120 to GDP. You normally see countries really start to get in trouble when that crosses 150. Now, clearly, you've got some other countries in here that are way higher. Japan's at 290. You've got some of, Italy's at 160. But normally, when you get to 150, that's when the cracks start to appear for a normal country. We're not a normal country. We also are the reserve currency of the United States. And that's going to buy us some protection. For how long, we don't exactly know. But it does buy us some protection. Most of the projections have us that if we kept on this trend, we would hit that 150 number somewhere between 2040 and 2050, give or take. Now, that can be dramatically changed by who puts those estimates together, what we think the government will do, which tax packages will go through, how much GDP will grow. But that's the thought process, is somewhere in that range. If we haven't figured this thing out, we start to get into trouble. And that seems wrong, just intuitively, that we all have to balance our books, right? Why doesn't the government have to balance their books? It's one of those things. We live in a world where there's so much debt out there and there's so much interconnectivity. And by being the reserve currency, the only thing that stops us as the United States from having unlimited debt is the fact that the world trusts us. So it's a confidence game at that point. So as long as the world has confidence in the United States to be able to pay this back, there's not, I guess, a underlying reason why you can't have that debt. Now, there's philosophical, there's moral, there's all the things. There's the things that, in the next couple of slides that I'm going to talk about, that as the debt grows, it makes things harder. But there's nothing stopping us. There's no person out there saying, hey, you can only go to this, other than ourselves. If that same website will show you this, our debt persistence, $108,000, call it, per taxpayer is $323,000 if you just take it across. So I mean, it's those numbers are significant, and they're not getting smaller. And this is kind of where it comes from. Our total outlays. This is the 24 budget, and this is off the CBO, so take it for what it's worth, right? $6.8 trillion. Social Security, Medicare, Medicaid, income security problem, and other being on that mandatory spending. You got non-defense and defense spending and discretionary. That beige area, the $881 billion in interest, that's the problem. We're starting to get to the point where it's crowding out these other expenditures. And as we do that, something's got to give, right? Do we have the money to invest in infrastructure, in research and development, in departments, whether it's energy, education, whatever department you want to put the money in? We're crowding that money out. And eventually you start crowding out defense as well. And so from a national security standpoint, especially as threats are not decreasing in the world, we're seeing increased amounts of threats and need out of the military, and we're potentially going to be crowding that out just because we have to pay on our debt. Because once we stop paying on our debt, that's where that confidence game comes into place. We look at our income. This is, that gap. So we were, 6.1, let's go back. Yeah, 6.8 trillion in outlays in 24, 4.9 in income. Making it worse by $2 trillion each year, right? And that's just getting worse and worse. So I'm not saying the taxes should go up. That's not where this is coming from. But we either have to get more, it's an equation, right? You either have to have more revenue or less spending to make the problem not be as bad. So most of it comes through individual taxes. You can see where corporate taxes, payroll taxes come in. But we're not pulling in the revenue that we need. So we have to find a way within our systems to either have rational discussions in Washington. And I realize don't hold your breath on that, right? But in theory, who knows? Maybe putting term limits in would change that. But we either have to get less spending within the programs, whether it's in wasteful spending or contracts or whatever it is, or if it's in just reform and how we do things. And we probably need a little bit more revenue from somewhere. So this is kind of what I was talking about. Yeah, the limited responses in emergency. That's another thing. We've kind of gone from emergency to emergency, and that's one of the reasons why we're in this position. So we went through 08, 09, so the financial system collapses and we pump a lot of money in to save it. I don't think that that's necessarily the worst thing. That's kind of why a government exists, right? Is to keep its citizenry above water where they can. Could we done it differently? Probably. COVID, we pump a ton of money into the system. Well, it's all got to get funded somewhere. And so the question is, for that next emergency, whether it's pandemic, whether it's war, whether it's whatever it is where the government needs to be the backstop, will we have the ability to do it? And each time we add one of these things, it makes it harder and harder. So our ability to respond to emergencies is what keeps me kind of up at night. I've got 3 boys, as Ken was saying, 16-year-old who's driving. So be careful if you see a Subaru with a lightsaber on the back of it. He's going to be going slower than most. So just, you might have to say, well, why didn't he go there? Type thing. And then I've got 2 10-year-olds. And by the time they hit retirement age, we're past that 2050 number, so that keeps me up. Is like, what's going to be happening long term? Next 20 years, probably, other than it being, we need to do something now, because the earlier you fix the problem, the better, but probably not as much impact daily lives. But if something were to happen where we needed the government to step in, are they going to be able to? And then all the choices of what do we spend. That foreign government manipulation is going to be a risk. So yeah, China right now probably isn't going to sell debt, but if our debt gets worse, they get more of it. It just leaves us exposed to things like that. The reserve currency. This is kind of our, ace in the hole as the United States. Right now, there's not another option. Nobody wants to have China control the currency of the world. The euro is going to be that option, and clearly the euro has problems as well. You may see some other instrument. Call me crazy, but I don't think it's going to be digital currency, because there's too many issues with Bitcoin and all the other things. It could be, but not in the form that it is right now. But at some point, if our problems exacerbate and we lose reserve currency status, I think the problem is going to be is it's an accelerant at that point. So while it's holding it back right now, if that goes away, it goes away quick. And that's going to be, for me, what I watch kind of consistently. So as long as we've got global trust, it's a scary issue. It's not a tomorrow issue or a today issue. Is it a 3-year issue, 5-year issue, 20-year issue? We don't know yet. But it's not getting smaller. And that's, I think, the worry for me. It also underpins diplomacy. And there's clearly people in this room who know this a lot better than I do. But our ability to put sanctions in on other countries is dependent upon the fact that they need our dollars. If they don't need our dollars, they don't have the ability, what sanctions can you put to restrict? And so there's all these ancillary issues other than the fact that we just owe a lot of money to a lot of people. And that's going to be a big one to play out. So what's the potential solutions? Growth, right? I don't care how we get there necessarily. We need to be growing GDP at 3+% to outpace or to keep, because in theory, even if you're adding debt, if your economy is expanding at the same time, it's kind of like, okay, my credit card limit went up, but I also went from making $100,000 to $150,000. I can take on more debt. same type thing. So if we can get the economy growing, and obviously this is where nobody in Washington can agree, whether it's tax cuts, whether it's government spending, whatever you want to do, but we got to grow. We have to have some fiscal discipline. I know, like I said, don't hold your breath. And entitlement reform would be within that fiscal discipline. So those are really the big ticket items on how we can address it. I'm sure there are other ones that on the periphery will help, but those are normally the ones that don't get done anyway. And even if they did, if you don't get the big ones in, if you don't put the big jars in the, or big stones in the jar first, it really doesn't matter. But we've got to find a way to grow. And that is actually where I find comfort in the idea that America has consistently found a way better than any other country in history to figure out our problems and grow. We may hate each other along the way. We may disagree about how to get there, but the one thing that we have been able to trust in is American ingenuity and the ability to do the things that need to be done, maybe at the last moment. We're a nation full of procrastinators and ADHD people. So, but I do have hope, that we have the ability to do that. And there's a lot of ways to get there. That's kind of the broad picture of inflation and national defense based upon the debt. But I'll pause there and answer any questions.